Hi everybody, Marcel Leblanc here. I'm here with Mathieu Roy, VP of Equities. How's it going today, Matt?
Great. You?
Good? Going great. So Matt, there's a lot going on in investment markets as per usual. Could you tell us a little bit about what we've been seeing in the last quarter or so in investment markets?
Sure. Well, we started off the year, equities were off to the races. Really, there was enthusiasm in the last quarter of the year. So Q4 was strong. The first 3 quarters of the year weren't quite as strong.
Right.
So why the change in sentiment? You started having data where investors got excited that central banks might be towards the end of trying to fight inflation. So they've been hiking interest rates rapidly to fight off inflation. We're starting to see some of that data cool. So you had investors beginning to think that we might be towards the end of that and we could pivot, the central banks could pivot and start cutting interest rates, and that could refuel the investment cycle or the business cycle. There was some wavering towards the end of the quarter, so January was really strong. February and March, it was, the markets were wavering. The markets held on to their gains, but we started to see some cracks in the system. So you're trying to slow down the economy, and parts of it worked. You had a few regional banks that were struggling. Investors ended up maintaining the gains because those issues were limited to those 2 regional banks. So we didn't have significant contagion across the system. If you look at across the different geographies, everything really performed well. You had Canada doing well despite energy being weak. Energy in Canada is very important for the economy, but also if you think about the stock market or how the composition of the market is in Canada, it's a big sector.
For sure.
And when you had that waver towards the end of the quarter, it really had an impact on oil prices.
Yeah.
So that sector did poorly, but the other 10 sectors were up for the period.
Exactly.
So we had broad-based strength. Whereas global equities were strong, and part of the reason was technology. It's a big component. And if you think interest rates are going to fall, those companies, because they're longer duration in nature, because their cash flows last longer and are backdated, it has a bigger impact on them in terms of valuations. You had those sectors leading the way on the global equity front.
Right. So could you provide a little bit of clarity or insights on what we might see going forward and how we've been positioned to kind of absorb that? Or
Sure. So we're very pleased that markets had a good quarter. We're also a little surprised by the strength and the resilience of all risk markets. The reason is we're still in tightening mode, and maybe central banks are done hiking interest rates, but it's not a done deal that they're going to start reducing interest rates right away. They really need to see some clear progress, and they really don't want inflation to persist in the system.
Yeah.
So you're going to have higher interest rates continuing to affect the real economy. You're going to have people, they're going to have mortgages that are going to have to be refinanced at higher rates.
Yeah.
That's going to have an impact on the economy. Businesses will probably take on less projects because financing is more expensive. Earnings will be challenged for businesses. So you're still in an environment where you're going to have some headwinds in the near term. We completely understand that the market wants to look through that and say, well, once we pivot, we're going to reduce interest rates, we're going to push back the investment cycle higher. And really, the biggest mistake you can make is not being in the markets. So you don't want to miss that.
Right.
But there is a balance, and if we look at it today, we think that we're in a neutral to slightly negative investment proposition for equities in the near term. So the way that we're positioning our clients' portfolios is to be neutral equities or maybe even slightly defensive from an asset allocation standpoint.
Yeah.
But even within the strategies, we've been shuffling some of our positioning towards more defensive businesses.
Right.
So we're happy. We've created a lot of gains for our clients in terms of our positioning. We're trying to lock some of those in as we speak.
Great.
But thankfully, if you're an investor today, not long ago, we called it the Tina trade. There is no alternative. Today, with higher rates, if you're being slightly more defensive on equities, well, your alternative is reasonably attractive.
Yeah.
The money markets are paying attractive rates. Short-term bonds are as well,
Yeah.
as well as regular bonds. So you're getting, as an investor, you're getting some attractive asset classes in the near term and long term.
Right. Well, that makes sense. Well, thank you very much for those insights. Hope that was insightful for you guys. Have a good day.